So what is it that really triggers one of those massive generation-defining financial downturns? I'm talking about events like the 2008 crisis or the crash that kicked off the Great Depression. What's actually happening right before the bottom completely falls out? Well, let's pull back the curtain and see what history can teach us.
You know that feeling, right? The fear of waking up one morning to see your investments just gone. It always feels like these things are totally unpredictable, like a lightning strike from a clear blue sky. But what if they're not?
I mean, think back to 2008. When that housing bubble burst, home prices in some of the biggest markets just plummeted. We're talking down by as much as 40%. The impact was absolutely devastating, and for so many people, it really did feel like it happened overnight. But here's the fascinating part. Major crashes, they're not actually random. It turns out they're almost always preceded by a series of recognizable signals, these patterns that just keep repeating throughout history. And if you know what to look for, you can actually see them coming. To figure out these patterns, we're actually going to travel back in time, 400 years to be exact. Why? Because the human psychology that drives markets to boom and then bust, it really hasn't changed all that much. We're going to trace a path through history to uncover 4 patterns that pop up again and again and again. All right, our first stop is the Netherlands. Way back in the 1600s, it was home to the world's very first documented market crash. And believe it or not, it was all because of a flower. So in the 17th century, the Netherlands was living through its golden age. They were dominating global trade, money was just flooding into the country. And oh yeah, they had just invented the world's first stock market. All of this created the perfect storm, the perfect environment for the world's very first speculative bubble. Tulips became the ultimate status symbol, but things got, well, completely surreal. People weren't just buying flowers anymore, they were trading contracts for tulips that hadn't even bloomed yet. At its absolute peak, a single rare tulip bulb was worth the equivalent of $200,000 today. That is the price of a house for a flower bulb. Now this quote, this is what really captures the mood of the time. It comes from a pamphlet written back then. When a skeptic warned a tulip grower that things might not last forever, this was his response. The confidence was just absolute. Any idea of risk was completely laughed off. And that, right there, perfectly illustrates our first pattern: rampant speculation and investor overconfidence. It's that moment when people are buying something not for what it's actually worth, but because they're totally irrationally confident they can just sell it to someone else for more money tomorrow. It's a hype cycle that feels brand new every single time it happens. Okay, let's jump to our next example. We're going to see how this pattern of overconfidence can mix with another really dangerous ingredient. We're fast-forwarding a few hundred years to right before the biggest market crash of all time, the crash of 1929, the one that kicked off the Great Depression. Now, to really get our second pattern, you have to look at how the government was, or in this case, wasn't, acting as the referee. See, back in 1907, regulators cracked down way too hard and way too late, and that actually helped trigger a panic. So by 1929, because they were so afraid of a repeat, they did almost nothing at all, as all these new, risky financial products just ran wild. This quote from President Coolidge, it just perfectly sums up that hands-off, laissez-faire attitude of the era. The government simply didn't want to mess with a good thing, even as the whole system was becoming more and more unstable. And that reveals our second pattern: regulatory shortcomings. This is what happens when the guardrails for the financial system are either missing, totally outdated, or just poorly applied. It's a failure to find that sweet spot, that right balance between letting things grow and keeping things stable. All right, let's jump ahead again. This time we're going to the 1980s, Wall Street's whole greed is good era. This is where a totally new kind of danger popped up, supercharged by technology, and it reveals our third pattern. So the big, hot new innovation of the day was called portfolio insurance. And honestly, it sounded like a genius idea. A computer algorithm that would automatically sell off little bits of your stock if the market started to dip, protecting you from huge losses. You can think of it like an automatic seatbelt for your portfolio. And here it is, our third pattern, a poorly understood innovation. The problem was, this seatbelt was so new and so complex that almost nobody really understood the risk. I mean, what happens when everyone's computer tries to sell at the exact same time? Well, you get an avalanche. And on Black Monday in 1987, that's exactly what happened. It proved that just because something is new and shiny doesn't mean we actually understand its consequences.
Okay, now for our final pattern. Let's look at a crash that a lot of us remember all too well, the 2008 financial crisis. This event combined all the previous patterns we've talked about and added one last explosive ingredient to the mix.
The whole mechanism was super complex, but the effect was pretty simple. Banks were handing out mortgages to basically anyone, a lot of times with little or no down payment. Then they'd bundle up thousands of these risky loans into these complex financial products, get them stamped with a safe rating, and then sell them to investors all over the world who had no idea they were basically buying a ticking time bomb. And this brings us to our fourth and final pattern, the buildup of debt. All that easy credit and massive borrowing fueled a housing bubble. This leverage, it's like gasoline on a fire. It amplified all the other risks we saw, the overconfidence, the regulatory failures, the complex new products, and it made the entire global financial system incredibly fragile. So, we've seen the four historical patterns. Now for the most important part. How can you use this knowledge to spot the signs of a future crash and maybe even protect yourself? You know the saying, history doesn't repeat itself, but it does often rhyme? Well, here are the four key questions you can ask yourself to spot those rhymes. Look for overconfidence, look for gaps in regulation, look for innovations that feel a little too much like magic, and look for a system that's just drowning in debt. These are your warning signs. And okay, what if a downturn does happen? What should you actually do? Well, first, don't panic and sell everything. Crashes often come with inflation, and inflation just eats away at cash. Second, don't bother trying to time the absolute bottom. It's pretty much impossible. Instead, the smart move is to see downturns as a big sale, and if you can, invest more. And what about alternatives like gold? It can feel like a safe haven for sure, but this chart shows you why a long-term perspective is so crucial. When you factor in dividends, stocks have consistently outperformed gold over the last 30, 50, and even 100 years. So, at the end of the day, market crashes can be really scary, but understanding these patterns means you don't have to be caught completely off guard. So, I'll leave you with this question to think about. As you look at the markets today, what rhymes of history are you hearing?